All right. So, welcome back to the channel. Let's talk about asset classes. Basically, an asset class is a type or a group of investments that you can own that can increase in value. Investments inside of an asset class are going to behave very similarly to each other. Throughout this channel, you'll see me discussing the following asset classes: stocks, bonds, cash, commodities, cryptocurrency, real estate, and all that, all that falls under finance theory. We'll be discussing that as well. But basically, yeah, just everything there, except for inflation at the top and finance theory. The asset classes are everything in the middle there. So why do we invest in asset classes? We invest in asset classes according to how well they perform when compared to inflation. As you can see on the screen, it shows you there that the asset classes, how they have performed compared with inflation. So, for example, stocks historically have, um, you know, gained or grown 10% versus inflation has grown 3%. So if you were to have invested in stocks, you would have outpaced inflation by 7%. Let's talk about finance theory real quick because that's one of the bullet points on this screen. Finance theory is the study of how these asset classes move up or down in value over time. It's a study of how all these different asset classes move up and down in value over time. And many years ago, some really smart people decided to study how these different asset classes moved and performed over many years, sometimes even decades, and sometimes, like in the case of stocks, over hundreds of years. For example, also real estate has been around forever. So if you were to have owned land and sell it later on, you were someone that's invested in the real estate asset class. So, in general, these asset classes move up and down in price at different times and for different reasons. So, for example, in 2022, let's draw a line that represents the direction of the stock market. So, we'll do a line that is going generally in a down direction, right? The market spent all of 2022 going downward. And at the same time, oil, um, the commodity oil was going up in price. Oil will represent oil as a black line. So we'll start over here with oil. So oil spent all of 2022 going up. So this will be oil. This will be stocks. So if you had invested, let's say, an even amount of money into stocks and oil at the same time, your portfolio would have balanced out. You see, it all kind of balances out here. If you had had all your money in oil, well, your money could have doubled or tripled when the stock market was crashing. But if you only had your money in the stock market, for example, then you would have spent that whole year losing value. So this is a really simple example of just two asset classes. Well, I mean, this is a commodities and stocks. So this is a really simple example of diversification, right? You want to be invested in something that goes up. You also want to be invested in something that's coming down. But then when oil starts coming down, stocks start coming up. So they start doing like a zigzag motion on each other. There's also a thing called long-term return, or how much money has this asset class gone up by over very long periods of time. If we look at the slide, we can see that asset classes like stocks and real estate have averaged long-term returns of 10% per year.
Does that mean that you're going to earn 10% on your money every year if you invest in stocks? Not quite. That 10% is an average return. Some years stocks can fall by 10%, and the other years they can go up by 30%. If you add up negative returns of 10% with a positive return of 30%, you get an average of 10% for those 2 years.
Pull up a calculator here. So let's say, for example, you were to get negative returns of 10%, positive return of 30%, and then take away the 10% negative return. And then, let's see here. So what does that equal? We'll divide that by 2. We get an average return of 10% for those 2 years. So some years, since 1926, some years the market has lost 30% or more in value. Some years the market's gained only 2% in value. And some years the stock market gained 20% or more in 1 year. Over 100 years, if you were to add all these returns up, these returns and losses, you get an average number of 10% per year. That's how they came up with the long-term return of stocks being 10%, because that's just what all the gains and all the losses over 100 years have averaged out to. It can be a bit confusing if you're not in the math, but if you pull up a long-term chart of the stock market and look at its general direction, it's overwhelmingly going up in direction. Let me pull up a stock market chart. Let's go to Yahoo Finance real quick here, and let's pull up the S&P 500, and let's look at a long-term chart. So here, this is a 5-year chart, right? And you can see its general direction is up, even though we had COVID in 2020, and we had the inflation and recession of 2022. But even through those two events, the market is up at the end of the 5 year. If we zoom out even further, you can see since 1929, in 1929 was the market peak right before the Great Depression happened, and stocks tanked for a few years there. But we got out of it. The market kept rising. It did take a long time for it to get back to pre 1929 levels, all the way up until 1954. So almost 20 years there. But we did get out of it. So you could see, from the bottom all the way to the top of today, the general direction of the market is up. So you can draw a line, and if you were to put your money in the stock market 100 years ago and close your eyes, and somehow you woke up 100 years later, you would find that your money is worth more than what you started at. So that's kind of the point there. So the point here, you can invest your money into several asset classes, or you can invest your money in only one asset class. Right? You're not forced to only invest in stocks or real estate. You can diversify and put money into multiple of these asset classes. It's kind of up to you. In a future video, we're gonna talk about the first asset class, stocks. But first, let's just do a few questions real quick to check your knowledge. Question number 1 being, is land and a house, are these asset classes? Is this an asset class? If you own land, do you own an asset class? Let's think about that. And I'm going to say no. And why is that? And that's because a house is an asset and land is also an asset, but they're not the asset class. Remember that an asset class is a group of investments. So a house and land are both assets in the asset class of real estate. Assets like houses and land are inside the asset class called real estate. And that's going to do it for this video here. Join me in the next video. We're going to talk about stocks. I hope to see you there. Don't forget to hit that like and subscribe so you can get alerted to the next as soon as I post new videos. See you in the next one.